Okay, well, thank you, Christian, for your invitation. It's nice to be here after 3 years that I spoke here for the last time. Let me just do a brief introduction of what we do. We're just an independent fund and management company, a long lead, very traditional, with over 20 years old now of investment track record in our only management fund, with some 150 million euros of assets. Very much aligned with investors, as all the managers invest our own savings in the fund for many years. So just getting into the company that I will be presenting today is a company that I did introduce here 3 years ago. And the reasons why I'm coming back is because, of course, it went very well, and from time to time it's always good to see that things that you're thinking about as good investments did work. But the main reason for being here today with this company is because we still believe there is a lot of value to be delivered to shareholders over the next coming years. Out of the past return, we managed to get some sort of 29% compound annual growth since 16. And as you will see later on, we still believe there's some sort of decent levels of return coming forward. Okay, so I'll try to explain it as we go through the presentation. So a few slides just to make up your minds in terms of how profitable this business has been over the last 18 months. In terms of book value, the company has compounded about 20% over the period. Written premiums, which is basically the level of growth in terms of sales, same level, above 20% in terms of compound growth. Local market share, compound growth of 10% over the same period. And return on equity, although a little bit volatile, it's been pretty stable once you strip out some growth effects from the net profit. But I will say that in general terms, it's been north of 20% once you adjust for that growth effect. And of course, taking into account all what I mentioned, the EPS have grown in line with the previous level of growth, north of 20%. So what is the company, just to recall a little bit, this is the leader car auto insurance in Mexico. Okay, it was a company founded in 1994, and Mr. Brockman, who is still running the company, just made a tremendous, terrific work in that regard. Today, the company is holding around 30% market share. It's still owned by its manager and founder, with the rest of the team on the day-to-day basis. And I will say that it's a very simple culture in the company, which is a very good service, very efficient in terms of costs, and always with a very clear vision of what they want to do in the mid and long term. And what I can say is that since we've been invested in this company, we've seen the company acting strategically every time. And so they do not care about the short term, but basically they're very much focused on long-term profitability of the business. So they started a little bit of diversification some years ago into some other South American countries. Still, that activity is very narrow. I think it won't count more than 5% of actual sales. As I mentioned to you, it's leader by far in terms of market share. Next competitor will have some sort of 10% market share. And the company is leader both in terms of car written premiums and trucks as well, which is very important. So they do hold like 20% market share in cars and 40% market share in trucks. The good thing about having 30%, of course, of your market is that it makes you be very effective because of the scale. Okay, I can give you a lot of examples. I've just put a few of them here, but they do have a lot of synergies in terms of spare parts for repairing the cars, of course, medical costs, healthcare costs, everything that is related to the claim. They do have a lot of important price power, and that, of course, is making them being very efficient in terms of pricing at the end of the day. So the whole presentation, it's based on what I'm going to just talk about right now, which is market penetration. I mean, Mexico is a still very underpenetrated market in terms of car insurance. Just to sum up, only 3 cars out of 10 are actually insured. As from 1st of January this year, there's a mandatory obligation that any car that would be driving by national or federal roads must have at least a third-party insurance coverage. We personally don't think that the enforcement of this law is going to be very active, but we will see that progressively we believe that's going to be, getting more and more pressure on people, and we will see afterwards that the real dynamic that is making the penetration of auto insurance grow over the time has more to do with the fact that cars are more and more being financed by loans. I'll go through that afterwards as well. So just a few numbers as well in terms of the country is not only low in terms of penetration of insurance per car, but it's also very low in terms of cars per each 1,000 inhabitants. So there are 2 dynamics in the market that are helping. More cars coming into the market and more insurance coming into the cars. The country has moved, this is also a very important data, the country has moved over the last years from importing a lot of old cars, second-hand cars, mainly from the US, that had almost no value, so therefore no motivation for insurance, to buy more and more new cars. The reason for that is because there's a new regulation that has a lot of taxation in terms of importing second-hand old cars from the US. So if you see in the graph, you see from 2008 until 2013-14, the red column was very high. That means that out of the total cars that were just sold in the market, a big portion of those cars were basically second-hand cars. Since 2015, where the regulation changed, most of the cars that are sold are on the blue line, which is basically new cars. And most of these new cars are financed by law, around 70%. And those cars are basically forced to get an insurance because of the loan terms. You need to have an insurance over the life of the loan. So that is changing the dynamic, and that is changing the penetration in the market. Slowly, but it's there. So again, just a slide on how finance is behaving. 10 years ago, the average loan would be, out of the total new cars sold, between 50 and 60% of the cars were sold through loans. Today, we're reaching 70%. And that dynamic, I think, could be even increasing over the coming years. So a little bit more same information. The average duration of a loan is between 37 and 72 months. So we're talking about of long-term loans. That means that multi-annual written premiums on car insurance are there because of the duration of the loans. And that has also a very important impact on the P&L of these insurance companies. Penetration, insured vehicles over the last 7 years, we moved from a penetration of the insurance of 27% up to 31% in 2018. We calculate that half a percentage point of penetration is taking place each year. And of course, the fleet, the new vehicle fleet is also growing. We moved from 33 million cars in 2011 up to 45 million cars last year. So there are these 2 dynamics. new vehicles, and also a higher level of penetration. No? And this is, I think, a very important slide. If we add the underlying growth of new vehicles plus the higher penetration of insurance vehicles, and on the top of that, we add the value of written premiums, which is not only calculated based on the higher level of penetration of the insurance, but also the average value per car in terms of the premiums. We see that the annual compound growth for the last 7 years, it's been close to double digit in terms of the value of written premiums for car insurance. Inflation, it's playing a nice and very important role in terms of creating value in these companies. So without further delay, let's get into valuation. A very simple approach to this kind of companies is the typical non-life insurance company or property and casualty company where you have two businesses, insurance business with historical normalized average, underwriting average of 5%. And as this business is 3 times as big as the equity of the company, the company has an equity of around 10 billion pesos, and they're selling around 30 billion in insurance premiums. 5% margin means 50% return on equity pre-tax. That, of course, once we deduct the tax will be low. On the other side of the slide, we have the other part of the business, which is the traditional float. The company has some 30 billion pesos in float as of today. And across the cycle as well, they managed to get some sort of 5% margin on that. So if we add to the two businesses, we reach some sort of 30% pre-tax return on equity. And that has been very stable over the last many years. So if we strip out the 30% tax, we end up with return on equity of around 20%. Is very much what we said in the previous slide of the average return on equity of the company. So very simple and straightforward approach to valuation. This is the actual situation. That is basically we get the insurance business from 2018. We got 1.2 billion of net profit from the insurance business and another 1.2 billion of net profit from the financial results based on the float. We reach a combined net profit of 2.4 billion. Total equity is 9 billion. So last year they managed to make 26% return on equity, slightly higher because the combined ratio last year was a little bit lower than 95%. So the company was trading a few days ago close to 20 billion pesos. That is makes the company trading as of 2018 results at 8 times profits to 2.5 times book value, which is, I would say, as a start point, a very decent valuation for a company that is supposed to be growing at double digit over the coming years. So a little bit of numbers. Basically, we are assuming a very conservative EPS growth over the next couple of years. The reasons for that is because we believe the market is slowing down a little bit. And not only the market is slowing down, but we believe that the company itself is sacrificing a little bit of market share in multi-annual written premiums. The reason for that is because multi-annual written premiums means that you fix the price for several years with your client, and you have not too much room to change the price in case you suffer from inflation in your claims. So they grew a lot in terms of multi-annual premiums over the last years, and they're now thinking on just strategically leaving all the competition to enter into that business so they can basically manage a better pricing in the whole portfolio of written premiums. So the very important thing here is the company today has a lot of solvency margin. That is, they do have an excess of capital of around 3 billion pesos, which is, roughly speaking, 15% of current market cap. When I say excess of capital, it's excess of capital of what they have set up as a buffer of capital above the legal requirement. They already have 200% excess of capital, and normally they will tend to be in 150% excess of capital. So that means that today there's a lot of cash to be distributed back to shareholders. On the top of that, what we have is a company that if we assume that they are not going to need a lot of capital for growth purposes, we believe that there is an additional amount of cash generation that will be distributed to shareholders over the next 24, 36 months. So we end up working these numbers, and we basically say that around 4 billion, 3.7, around 4 billion pesos could be distributed over the next 3 years, either through dividends or buybacks. The company has been very active in terms of buybacks over the history. Actually, they're buying as much as 700 million pesos. As we speak, they're buying back shares. They are about to amortize some 10 million shares that they already bought last year. And we still believe that as the company is generating, roughly speaking, 2.5 billion euros of net profit, and that net profit is a very good proxy of free cash flow. If you don't need to apply part of that net profit for growth, the spare amount of cash flow that's going to be generated is huge, because 2.5 billion net profit over the market cap means that you can use around 12-13% of free cash flow yield to either buy back shares, give dividends, or if you want, put an excess of reserves on your capital for growing purposes. So this is the historical underwriting margin. 95% combined ratio means they managed to get 5% return on their underwriting activity. This is historical float return. I must say that over the last 3 years, they did a little bit did poorly. Let's put it that way. I think they haven't done a great job. They used to have a good asset allocation. I think they've made a few mistakes over the last years. But the good thing is that we're taking only 5% return on the float as for our forecast. And just to give you a sense of how quickly they can change this, Treasury bills in Mexico, I mean, they're called FETEs, are yielding, as we speak, 8%. If they rotate a little bit of the investment portfolio over the coming, as they are doing over the coming months, probably we'll be seeing a higher return on float just because of a higher exposure to Treasury bills. But we are being just conservative in that regard. So with that two returns, as I mentioned to you before, return on equity, we should expect 20, north of 20% over the coming years. And we reach a target valuation for 2020, which is around 40% higher than the actual price. Basically, we're seeing the company with a combined net profit for north of 2.5 billion pesos, and the target equity for 2020 will reach some 13 billion pesos. If we apply a multiple of 2 times book value, which is basically something that we believe will make it sense, 10 times PE, we reach a valuation of close to 26 billion. No? Outstanding shares at that time will be lower because they're buying back and amortizing shares constantly, so we reach that target price. So putting everything together, the amount of excess of capital that could be returned to shareholders plus the expected, let's say, target price for the share, we reach a compound return target of around 24-25% compound over the next 3 years. And this is our scenario, let's say, and the reasons why we still believe that this company is worth to be invested. It is today our largest company in our portfolio. And just to share with you the company guidance, we believe this is reachable. It's nothing strange on the guidance. And just to share with you a little bit of the sensitivity analysis that we've done. Of course, the company is very sensible to both combined ratio and float return. So each 1% fluctuation means that the figures that I mentioned to you could move north or south easily. But of course, we know that this is something that's been happening over the years, and we know that at the end of the day, what I have to do is normalize and take a little bit of an average return and an average combined ratio, which is what you should do in order to better understand the risk profile of this company. A little bit of conclusions here. I mean, the management is a high-quality management, very much aligned with shareholders, very prudent, and with a clear strategy. The franchise works very well. It works through a big network of agents that are very much aligned with the profitability of the client and not with growth. And still the market is really underpenetrated. And so the underlying trend, the underlying dynamic of the market is going to be helping you over the coming years. Actual valuation, I think, is very decent. The only thing that I will comment in terms of risk is that the management and the ownership it's getting older. And of course, they will be facing some sort of generational change at some point. And that's something that we're looking closely. Of course, we can talk about political environment with López Obrador. We believe that this sector is not the kind of sector that will be affected by any kind of irrational decision coming from a left party government. And of course, one of the risks could be the peso devaluation versus the hard currency, in this case versus the euro. But the good thing of the company is that it has a very natural and good hedge against devaluation, because the higher the inflation, the higher the interest rates, the higher return on the float. And the higher inflation, the higher claims costs. With the décalage, those higher costs will be translated into pricing, as we have seen over the last years. And so the company is always offsetting the impact of inflation with a decent pricing policy and with a decent return on the float. So it's a natural hedge that we can talk about if you have more questions. So we feel very comfortable with that. So thank you, and hope it's been not too long. And maybe we're ready for lunch or questions, whatever.
Thanks for the presentation. I have two questions. First of all, I am not aware of the degree of penetration of online aggregators in the Mexican market. I don't know if this is something that has already occurred, or if these guys are thinking about it, they are doing something internally in this regard that could mitigate the impact on the underwriting business that they have. Mm-hmm. And the second question is, you mentioned that they are leaving some market share on the table. Why is that? Is there any pressure on the market right now?
On the first question, of course, the aggregators are there. The impact of the aggregators, of course, is how much you pay how much you pay in terms of capturing a client. I mean, it's all about your network. The company's network is not a cheap one. It's a very efficient and very profitable, but not a cheap one. So they do have as an acquisition cost, which is basically what you pay to all your network, will represent around 22-23% of the earned premiums. So, I mean, aggregators are there, and they do have also a space to grow. But I don't think this particular network of own agents, it's going to be very much affected by that fact. And I don't think that it's going to represent an additional cost in case they want to get through them to the market, because they're already paying a lot. Actually, they're paying 22%, and on the financial institutions, they're paying even more. They pay like 25, 27%. So it's not a, let's say, cheap network of acquisition. And the second question was why they are just stepping back a little bit from the market. As I mentioned to you, they've grown a lot. I have one slide over there, but they've grown a lot through financial institutions related to loans to the auto industry. That means that when you sign a contract with a client that has bought a car, you need to fix the price for that insurance for the life of the loan, and you have no room at all to change pricing. So it's okay, you have to participate, but if the blend of your premiums is very much focused on multi-annual premiums, the room you have for changing prices every year diminishes, and therefore they want to keep a certain level of market share, but from time to time they just sacrifice, let other competition get in, so they suffer a little bit that impact as well, and then they again come back to the market once the competition realize that they should rise prices as well, because otherwise you're committing yourself to fixed prices for a long time. I don't know if I have answered you, but that's the main reason behind.
Yeah, thank you.
Okay.
Hi, thank you. Just two questions. One, on the claims front, are there any legal regulatory issues that might increase the cost of claims, which they may not be able to raise prices enough? And secondly, on the quality of the investments, the book, if they're accepting lower returns because they're becoming more cautious, and so...
No, I think, on the first question, legal claims have grown over the last 4 years by 25%. I'm going to ask you I'm going to answer the question by facts. And they managed to increase prices by 30-something%. So it's always an issue, because you have, legal claims go up because of inflation and because of higher level of claims, either because there's stealing more cars or because you have more healthcare claims, whatever. So it's an issue, but it's an issue that it's always solved out by pricing increases over the time. And if there's any issue that would be affecting the whole sector, at this moment I can't recall anyone, but if there will be an issue with that, I'm sure it will be translated into prices. What they're doing, and it's one of the good things this company has in terms of size, is they're being very much effective in terms of agreements with repair car shops, agreements for suppliers, spare parts, hospitals, healthcare cost in general terms. They've been proactively generating a lot of efficiencies there. And we'll see more efficiency as we speak, because they're still generating a lot of good deals in that regard. And there was another question. No, the book, I think they made mistakes. Normally they have had a lot of exposure to equities. And actually they did good investments, but they suffer from volatility from time to time. I think they're just making up their minds a little bit, and we'll see more kind of a traditional breakdown of what should be the flow, in terms of treasuries and equities and real estate. But even assuming 5% in this macro environment, it will still be generating a very decent amount of return. We're not very ambitious in that regard. Of course, if they manage to get 100 or 200 basic points more on the return on the float, that will make a big difference in net profit. But we're still okay even at this level.
Thanks for your presentation. Are the competitors similarly profitable on a combined ratio? And if they are not, what is Qualitas doing better than the competitors?
I think competition is very volatile in terms of combined ratios. Some of them, they're good, but it's all about the pricing policy. Because in order to gain market share and competing with someone that has 1/3 of the market, you need to be in some sense aggressive in terms of pricing policy. Some margins will fluctuate depending on how aggressive competition will behave across the cycle. What I've seen is that competition hasn't been really an issue for Qualitas over the time. The only thing they've done is when they see competition, let's say irrational behavior coming from competition, they just they can sacrifice market share in order to let them realize that being aggressive in terms of pricing is something that at the end of the day you will have to pay. That's at least what we have seen over the last years.